my name is Gina Gabriela Quintero and I'm going to talk about the fundamental analysis. It is a type of stock exchange analysis that tries to establish the real price of a share through the study of variables that affect its value, and thus making a series of calculations to determine if the share is overrated or undervalued. This analysis considers that the market is not efficient and uses information from many sources like the structure of the company, macroeconomics and sectorial information, financial diaries, and rumors, but it must be filtered. There are two methods for this analysis. So the first is the macroeconomic analysis top-down. It consists of the idea that what moves the stock market in the long term are the main macroeconomic variables, because the stock market have to reflect the behavior of the economy. This analysis starts by the country, then the sector, and finally the company. There are certain macroeconomic variables that affect the evolution of the stock market, and those are: first, the interest rates. The stock market moves in the opposite way to the interest rates, because when the interests are low, the share price rises, and if the interest rates are high, the share price goes down. Second, the inflation. It is the continuous and generalized growth of the prices of goods and services and productive factors of an economy over time. Its main causes are demand, supply, and monetary inflation. Third, the exchange rates. This is the price of one currency relative to another, and the main causes of changes in exchange rates are inflation differential, trade balance, and investment balance. The currency depreciation affects negatively the stock market. Fourth, the public deficit. It is the negative difference between the incomes and the expense of the public administration in a long term of time. An increase of this deficit is not good to the stock market, and the main causes of the change of this deficit are the behavior of public spending and evolution of economic growth. Talking about economic growth, it's better to invest in low economic cycles, because the economic growth affects negatively the stock market, same that the exchange rates. The economic cycle has 4 phases, and those are the boom, the recession, the depression, and the expansion or the recovery. The second method of the fundamental analysis is the bottom-up analysis. This approach goes from the bottom top, from the particular to the general. That is, that it studies the company first, then the sector, and finally the country. In the bottom-up analysis, it exists 3 methods of assessment, and those are: first, assessment by dividends. It could be 2, dividend yield and dividend profit from stock valuation. Second, we have the assessment by multiple, could be 5. Those are price earning ratio, price earning growth ratio, value ratio, cash flow multiplier, and EV ratio. And there are other ratios of interest like financial profit, economic profit, earning per share, dividend per share, and cash flow per share. Finally, we have the discounted valuation of free cash flow. It consists in that the company's value is the actual value of the free cash flows, discounted at weighted average cost of capital.